Learning how to avoid losses in your funding portfolio will ensure you earn incredible returns, build long-term wealth, and become financially unfastened. For those who don't learn these techniques, so that will reduce their chances of losing money investing won't be very worthwhile, and is corresponding to gambling. These people will ultimately decide investing isn't well worth risking their money and they'd rather work until the day they die. No one likes losing money, however, investing to earn enough profit on the way to allow you to retire does entail a fair amount of risk. By taking note of these 8 important techniques that famous and extremely rich investors employ, you'll remain worthwhile when others are losing their lifestyle's financial savings. I help teach people about money, personal finance, and making an investment. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 7. Diversify. Diversification means spreading your investments around, and doing this will offer 3 predominant benefits. First, your risk will be minimized because your exposure to any single asset is limited. You're avoiding losses that could stem from one stock or part of the marketplace. An instance of this could be when a corporation has some unwanted news, resulting in a large decline in its price. Third, you're earning more steady long-term gains by spreading your money across many stocks. Proper diversification doesn't mean you simply own a variety of stocks. This also means that you should own numerous sectors and not become too focused in any single area of the market, whether it be technology, energy, consumer cyclicals, and so on. A huge mistake employees often make with their 401ks is purchasing too much of their enterprise's stock when it's presented to them at a discount. This could mean their company's stock makes up 25 or 50 or more of their portfolio over time. And this level of attention poses a massive risk. What if something negative were to happen to that stock? Having this many eggs in one basket could easily derail a retirement. Number 7. Have realistic expectations. There's nothing wrong with hoping for the best from your investments, but you could be headed for trouble if your monetary goals are based on unrealistic assumptions. Masses of high-quality stocks have generated market-beating returns, a ways outpacing what you would earn by just investing in the normal market. This truly doesn't mean you have to always expect the same kind of return. By taking a look at the stock marketplace's historical returns, this could provide insight as to what you could count on. Between 1957 and 2021, the S&P 500 has averaged 10.5%. This indicates there have been some years that were extremely profitable, and others when the annual return was negative. In 2005, the S&P 500 returned just 3%, followed by 13% in 2006, and 3% in 2007. But in 2008, the market returned negative 38%. During extended periods, whilst the market performs better than average, it's easy to get used to it and expect this every year going forward, but this is completely unrealistic and reckless. Range 6. Invest in what you understand. A famous piece of recommendation is to invest in what you recognize and avoid what you don't. One of the simplest ways to make an avoidable mistake is to get concerned in investments that are overly complicated or just something you don't understand. Most of us have spent our careers working in 1 or 2 industries, meaning you probably have a reasonably strong grasp on how these markets characteristic. On the other hand, the majority of publicly traded organizations are in industries we know little to nothing about. This doesn't mean you can't invest elsewhere. These investments should just be approached with caution. Investing isn't just related to the stock market either. There are many other ways to invest, such as purchasing fine arts, private money lending, owning gold and other precious metals, renting real estate, or buying businesses. Which of the many investments which are available is best for you will rely on your information. For example, an expert in fine arts would probably be better off sticking to that craft than picking individual stocks, because having a deep knowledge of what you're buying will lessen your probabilities of losing money. Number 5. Don't over-leverage. Taking advantage of that exceptional low interest rate by borrowing against your shares on margin can be tempting, but this could be the biggest financial mistake you can make. What in case you refinance your home and invest that money in the stock market, offering the capability to earn much more than the interest it's costing? This looks like a great idea when the economy is booming and profits are seemingly in no way ending. The problem with using too much leverage is that those debt payments become difficult to make when your earnings is interrupted or the value of your stocks drops by a massive amount, and you receive a margin call requiring you to promote your stocks at a huge discount. For most people, it's best to keep away from margin entirely and only invest the money you presently have. This could also be applied to borrowing against your home, or using any other form of loan. Using borrowed finances to invest can provide a major boost to your returns, but it's important to remember that leverage amplifies negative returns too. Number 4. Invest in line with your risk tolerance. Chance tolerance is the level of chance on. Investor is willing to take risk, can mean opportunity exhilaration or a shot at big gains, but risk is also about tolerating the potential for losses. It's the capacity to withstand market swings and the inability to predict what is in advance. When figuring your risk tolerance, it's important to apprehend your time horizon, or when you plan to withdraw the money you've invested. Do you propose on using investments to pay for a family vacation fund, college tuition, or is it there for your retirement? In case you're invested in unstable assets, it can be hard to be patient during short-term period swings and years of loss. Determining the right amount of threat you want to take will help you strike the balance of earning worthwhile profits and making the value of your money isn't eroded by inflation. Number 3. Don't chase gains. Simply because the stock was up 15 yesterday doesn't mean it will happen again today. Many investors get excited when they see earnings in one area of the marketplace, and they are tempted to chase the big winners, hoping they'll gain extra. This herd mentality generally involves buying in at a high price or selling at a low price after a sell-off. In place of following the herd, try to awareness on investments which are undervalued or are worth more than what they're currently priced at, ones that haven't been noticed or have been oversold. This approach, known as value investing, is what Warren Buffett implements, and it basically entails avoiding extremely popular stocks and investing in companies that might be left out to some degree. Sectors of the market and single stocks pass up and down. They might not be bullish all the time, and they won't be bearish either. Number 2. Have money set aside. One of the last things you want to have to do is sell your investments due to a loss of financial savings. Adding insult to injury, if you're required to sell some of your investments for the duration of tough times, it's likely to be when the market is down, or it could mean tapping into your retirement accounts, resulting in a penalty and an unexpected tax burden. Having an adequate emergency fund will suggest you may stay invested while you're faced with a surprise expense or a lapse in income, allowing you to keep your investments for the long term. Experts advise having at least 3 to 6 months of expenses set apart for unforeseen occasions. This seems like a lot if you have a constant activity. The market is growing step by step, and inflation is slowly eating away your savings, but you should acknowledge the truth that a bear market should strike at any time. Number 1. Don't sell in a panic. A marketplace crash, or even a small decline in your investments, can cause a lot of fear and anxiety among people who check their portfolio regularly or become overly absorbed in scary news headlines. No one enjoys seeing their money vanish, and will have you wondering if it will ever return. Investing in the stock market can be risky, and it comes with a lot of volatility. To navigate this efficiently, you need to maintain a long-time period investor mindset by wondering many years ahead. Historically, the market has always recovered, meaning, in case you're well diversified, you're going to be all right if you don't plan on selling even when it doesn't seem so. By taking a observed history, you will locate that a bear market, or when prices drop 20% or more, occurs about every 3.5 years and lasts an average of 289 days. By keeping this in mind, you may be much less likely to react negatively to such an occurrence, and you'll have a better idea of what to anticipate going forward. Keeping your emotions in check will help you make rational decisions regardless of market conditions. The most important worry of any investor is losing money and seeing their personal contributions shrink up to nothing. After all, the reason people invest in the first place is to protect the cost in their money and earn profits that will assist them accomplish their goals. By considering the most common motives for investment losses, you may use them to your advantage and learn how to avoid losses in your investment portfolio. This will help you sleep higher at night and maximize your returns.